Everyone wants to know one thing right now. Are interest rates going down? Are they staying flat? Or are we quietly being set up for the next rate hiking cycle in 2026? Because according to Canada's biggest banks, they all agree on what's going to happen in the first half of 2026, but they violently disagree on what comes next. Let's break it all down. Here's the punchline. All six big banks in Canada now expect the Bank of Canada will sit at the current rate of 2.25% through the first half of 2026. No cuts, no hikes, just stuck here. But from 2027 onward, the forecast splits into two camps. Three banks think rates will go back up. Three banks think that we're going to stay here and that this is the new normal. But historically, only a couple of these banks have been consistently right. And I will point out that nobody is showing rates decreasing moving forward. And this matters if you're choosing between fixed, variable, or coming up on a renewal. So let's walk through the camps here. Camp number one is rates go back up. One bank sees the first hike as early as late 2026. Two others see hikes in 2027. Endpoint forecasts range from 2.75 to over 3%, 3.25% at RBC in Q4 of 2027. The logic here is simple. Inflation settles, growth reaccelerates, and the Bank of Canada is able to normalize. The other camp is where rates stay flat. The other three banks say 2.25% holds all the way through to the end of 2027. No aggressive growth rebound, just structural stagnation. And this is a quiet but important shift. Half of the banking system is basically saying this might be as good as it gets. Now, let's actually talk a bit more about who has actually been right before. Then this is the part that most people skip, but it matters the most. Historically, some banks consistently lag turning points. Some banks chase the consensus. And one or two tend to actually lead policy shifts. So if you look back at the 2021 inflation persistence period, 2022 rate velocity, 2023 pause expectations, and the end of cutting expectations, the most aggressive forecasts were early, but they weren't wrong. The overly optimistic calls essentially on quick cuts missed badly. So when you see banks today promising long-term stability, you want to ask yourself, are they forecasting data realistically or managing expectations or just talking their book? Because banks don't just predict rates, they also sell products tied to them. So they have a vested interest in a certain outcome in many cases. If rates really sit at 2.25% through 2026, variable borrowers will finally get the breathing room that they had signed up for in picking the variable. Fixed rates will probably stay range bound. Renewals will stop being catastrophic, but not cheap. But if the rates go back up camp is correct, locking in fixed in 2025 could look smart for a lot of these people renewing. Floating too long becomes risky again, and leverage math gets tighter very quickly. And this isn't about calling the exact number. It's about risk management, not gambling on rates. I mean, people who are levered long in real estate are functionally bond traders through real estate, buying in 5-year increments. So my read is 2026 is probably boring. I'm still going to throw the Hail Mary out there that I think we're going to see a recession. So the risk isn't cuts not coming. The risk is people assuming rates can't ever go back up. And history would tell us that that assumption can be pretty expensive for people. I'm going to try and keep this one short and sweet. So if you want deeper breakdowns like this, hit the subscribe button. And if you're running real numbers on renewals, investments, or timing risk, I've got a bunch of free tools linked below at realist.ca that'll actually help you model this properly. Let me know what you think in the comments. Do you think that rates are going up this year? Do you think that rates are going down this year? Thanks a lot for taking the time to watch this video, and I'll see you again as soon as I can.